Hey, what's up, everybody? A couple of days ago, gold and silver was having a pretty bad day. Or if you were in the market to buy any sort of dips, maybe you looked at it as having a good day because metals were down. A couple of days ago, CPI numbers came out and was showing that inflation was still running hot, and that was beating down the price of gold and silver. Gold dipped below $2,000 an ounce, and silver was down about 3%. And maybe the markets overreacted to the CPI data on Tuesday, showing that inflation was still running hotter than expected. But we're in a time, in my opinion, where the markets are speculating on what Jerome Powell is going to do next. What is his next move going to be with the federal funds interest rates? And with every new piece of data that comes out and the market's trying to speculate or trying to guess when Jerome Powell is going to start easing interest rates, or when is that pivot going to start? Not just trying to guess for March, but now also in May and for June. Is that pivot or the easing going to start in March? Will it start in May? Will it start in June? Or will it be further out than that? Or is there that possibility, instead of easing interest rates, is there that chance that he could raise interest rates before the easing or the cutting begins? Jerome Powell has said in pretty much every press conference when he announced the new plans for the federal funds interest rates is rates will be higher for longer. The only question that always remains is, what does higher for longer actually mean? Which leaves the markets in limbo or with a lot of uncertainty, which keeps the markets guessing. That creates a lot of volatility, in my opinion. As I previously stated, metals did take a pretty decent sized dip a couple of days ago because of hot inflation data, but yesterday, metals started to recover, and today, metals continue to go up. We're going to discuss it on this video. Please consider hitting that thumbs up button on the video if you enjoy or find videos like this informative, and let me know your thoughts, your opinions in that comment section below. Before we actually get to what the market is reacting to, gold is now once again above $2,000. Gold is up almost 0.5%, or up $9.30 to $2,001.20. With silver typically being the more volatile of the two metals, silver is up a little bit more than gold. As I'm recording this video, silver is currently up a little bit more than 2%, or up 2.19%, up almost 50 cents to $22.82. Why are the metals getting a boost today? Well, more data came out, and that was retail sales. For this part of the video, I will be referencing an article from Kitco News by Ernest Hoffman. It says gold climbing to 2,000 after U.S. retail sales surprise with 0.8% fall in January. Gold prices are continuing to cling to the important $2,000 per ounce level after retail sales came in well below market expectations in January, while December's print also saw a downward revision. There we go with those revisions. U.S. retail sales fell by 0.8% last month following a revised increase. There we go with more revisions. A revised increase of 0.4% from 0.6% in December, according to the latest data from the U.S. Commerce Department. Economist consensus calls projected a 0.1% drop in January's headline number. Core sales, which strips out vehicle sales, were down 0.6% last month, also far below market expectations of a 0.2% increase, or compared to December's revised minus 0.4% reading. Spot gold whipsawed the minutes after 8:30 a.m. Eastern Standard Time release, but quickly returned to trading within a few dollars of $2,000 per ounce. It last traded at $2,000.21 and is up 0.39% on the day at the time of that writing. And as of the recording of this video, as I previously said, let's get an update on the gold spot price. Gold currently is up $2,001.30. Andrew Hunter, Deputy Chief U.S. Economist at Capital One Economics, said the report shows that consumption growth is finally faltering, or in other words, losing momentum. The 0.8% fall in retail sales in January may partly reflect the unwinding of a previous weather-related distortion, but should temper recent suggestions of an economic resurgence, he said. We continue to expect GDP growth to slow in the first quarter. Hunter said the headline reading wasn't quite as bad as it looked, since it included a 1.7% fall in gasoline station sales, which was at least partly driven by lower prices. But he noted an equal-sized decline in spending on motor vehicles, which, based on the manufacturer's unit sales data, will correspond to an even sharper fall in real consumption. The main surprise was in control group sales, excluding autos, gasoline, building materials, and food service, which fell by 0.4%, he said. That could partly reflect a reversal of the earlier boost to spending from December's record warm weather, with the start of January bringing snowstorms across much of the country, but that mainly appears to have hit sales of building materials, which plunged by 4.1% and aren't including in the control group total, and probably doesn't explain the 0.8% fall in online sales. Looking ahead, Hunter said the report indicates significantly lower growth for Q1 2024. Overall, real consumption appears to have declined in January, and even allowing for a recovery over February and March, growth will slow sharply in the first quarter, he wrote. The upshot that the Fed officials have not need to worry much longer about the possibility of continued economic resilience reigniting inflation. Touching a bit on a CNBC article that was released today, it says investors are closely watching the numbers for clues about which way the Fed will go in terms of monetary policy and interest rates. Federal Reserve officials have said they are satisfied enough with the prospects for both inflation falling and growth holding steady that the rate hiking cycle begun in March 2022 is likely over. But they are watching the data closely, with most saying that they will need more evidence that inflation is on a sustainable path back to the central bank's 2% goal before starting to cut. So why do I think this is good news for the markets? Partially because this is obviously not good news at all, with worse than expected retail sales. It's bad news for the economy, but that's what the Federal Reserve wanted to see. They want to see less spending, less money entering the economy to reduce inflation. So I think the Federal Reserve may see this as a good thing. I would like to touch on one key point by Jim Wyckoff, Kitco News. It says gold, silver rebound amid downbeat U.S. retail sales report. It says the report falls into the camp of the U.S. monetary policy doves who want to see the Federal Reserve cut interest rates sooner than later. My question is, the people who want to see interest rates cut sooner than later, or who think that interest rates will be cut sooner than later, is that reality or a bit of wishful thinking? Let's take a look at the CME Group FedWatch tool and see if there's any changes from a couple of days ago when I did my video on the hot CPI data. A couple of days ago, it was showing the possibilities of the Federal Reserve keeping rates unchanged. It was 91.5%, and easing by a 0.25% was 8.5%. Today, a little bit of a difference, but not much. As I'm recording this video, it's showing an 89.5% possibility that rates will remain unchanged and 10.5% possibility that rates will be eased by 0.25%. But of course, I'm recording this video on February the 15th, 2024, and that announcement is not scheduled until March 20th, 2024. So we still have quite a while to wait, and by then, anything could happen. In fact, speaking of anything could happen, before that March 20th date where the Federal Reserve will be making that decision, on March the 12th, before March the 20th, on March the 12th, that's when the next CPI data will be released, and my guess, that's going to have a lot to do with it. I do appreciate everybody for taking time out of your day to watch and listen to this video. If you found this video enjoyable and informative, please consider hitting that thumbs up on the video. Let me know your thoughts, your opinions in that comment section below, and I do appreciate you for your time. Like, comment, subscribe, share, and I'll talk to you on my next video. Thanks a lot, everyone.